All right, today we're talking about the 8 types of inherited assets and how they impact your financial aid. So, the 8 types of assets can be divided into 2 main categories. First, we have the retirement assets, 401ks and IRAs and those types of things. And then we have all the other assets, life insurance proceeds and cash and stocks and bonds and those types of things. Now, the challenge that we have with either type of asset is for retirement assets especially, they generate a lot of income when you take the money out of the account. So most retirement assets, the original owner who passed away probably didn't pay a lot of taxes on at least some of that money. And when they take that out, or you take that out as a beneficiary, you're going to have to pay the taxes that they were deferring. Now, the other assets, things like bank accounts and stocks and bonds, they don't necessarily generate as much income as you inherit it, but they do count as an asset when we figure out financial aid. So now we need to kind of understand how need-based financial aid works. There's lots of different factors, and that's why we fill out the forms, but the key ingredients when we calculate financial aid would be mom and dad's income and assets and the student's income and assets. Now, the typical student doesn't have a lot of income, doesn't have a lot of assets. They're just a young 18-year-old coming out of high school. So everything is mostly based on mom and dad's income and assets. Now, the one big exception to that I've seen a few times is I've worked with families where grandma and grandpa or an uncle or something leaves money directly to the student instead of to the parents. Well, when you do that, those assets are considered more heavily than if the same assets were in the parent's name. So ultimately, for financial aid purposes, putting assets in the student's name may not be a good idea. Now, the big caveat there, of course, is sometimes it makes such a greater difference in taxes or other reasons that you go ahead and do it anyway. So I'm not saying you should never do it, but you need to understand it will have an impact on aid. So let's jump into the assets. So let's talk about retirement assets first. So if you have retirement assets, IRAs, 401ks, those types of things, realistically you have 3 main options. The first option is to cash it out. You contact the company and say, hey, send me a check. And of course they'll do that. Now that may cause a major tax problem, and certainly you're leaving a lot of opportunities on the table if you do that. You could also disclaim it and say, I'm not interested in receiving my share of the IRA or my share of the 401k. Now, if you disclaim, then that piece of the IRA, your share, will go to the next beneficiary based on how the beneficiary forms were created for each of these accounts. So it may roll down to your children if you were to disclaim it, or it may go to other brothers and sisters or something like that. So you certainly want to know where it's going to go before you disclaim it. But disclaiming it is a great tool that we've used a few times where we were able to have the student disclaim the asset that was going to go into their name, and instead it bounced back up to mom and dad, and it helped us for financial aid purposes. Now, disclaimers need to be filed within 9 months, so there's a little bit of urgency. So that's within 9 months of date of death. So we do have to make our decisions and put a plan together and execute it all within 9 months. And then the third option, which is also a very popular option, is you can roll over that retirement plan or IRA, and you can roll it over into either a beneficiary IRA or a beneficiary Roth IRA, depending on what the original account was. So all the various Roth types of accounts go into a beneficiary Roth IRA, and all the traditional or normal accounts go into the beneficiary IRA. So IRAs and 401ks that have never had taxes taken out and are not the Roth option, they all can get lumped together into one big beneficiary IRA. And all the Roth options would be potentially consolidated into a beneficiary Roth IRA. Now, if we roll it into a beneficiary account of some sort, then we have more decisions to make. So then our next option is then to figure out how we're going to take it out. Now, what we can't do is we can't combine these accounts with our own IRAs or our own Roths. We need to keep them separate. And then we also need to take out minimum withdrawals potentially. And most of the time we have to cash it out over 10 years. So we have to take the money out over 10 years. We could take it out, in the first 3 years, 1/3, 1/3, 1/3. We could take out minimum withdrawals for a little while and then take out bigger pieces later. But in the end, after 10 years, the money needs to be gone. Another option that we still have is we can cash it out. So if it turns out after a year or two or after some planning, for whatever reason, we can change our mind and then just finish it off by cashing it out. So we don't lose that option if we roll it into the beneficiary accounts. And finally, you need to be aware that there are special rules if you're the spouse. So spouses can potentially take it over as their own, and they have some additional rules. So I've worked with families where one of the parents passes away, and then the widow is trying to figure out how to deal with retirement in this particular situation, and she could take over all the retirement accounts as if they were her own. But again, you don't have to do that. There's other options as well. And then finally, if grandma and grandpa or someone were to leave an IRA to a minor child, so if you've got 3 students and the youngest is 12 and they receive an IRA, well, there's special rules for that student as well. So they may have options to stretch it out a little bit further. Now, again, it could have dramatic impact on how financial aid is going to work out, so you need to be careful. But sometimes it works and you can plan around it as well. All right, so let's talk a little bit more about how all of this money is treated when it comes to need-based aid and the FAFSA. So if you have a beneficiary IRA, generally it's not an asset for financial aid, nor was the original IRAs and 401ks. So it's generally not an asset. But you're going to have to take withdrawals, and on a beneficiary IRA, that's going to be a taxable withdrawal. So you take your withdrawals, and then it shows up on your taxes. And then for financial aid purposes, because it increases your income, that flows through your taxes onto your FAFSA. So that will increase your income and potentially have an impact on your aid. If we talk about the Roth IRA, now the Roth IRA does not create an income tax. So when it comes to beneficiary Roth IRAs, you can take the money out and not have to pay taxes. Now that income may still flow through your taxes and show up as untaxed income on your FAFSA. So it can still have an impact on your need-based aid, even if it's tax-free. So I've had families thinking they can just take out all the Roth IRA money all at once because they're not going to have to pay any taxes when they take it out. Now the challenge there is once you take it out of the Roth IRA, well, now it's cash or another asset that you're going to have to report. So you may want to leave what you can in the Roth and take it out strategically, even though there's no tax ramifications. The next asset that we need to talk about are annuities. Annuities are relatively complicated, and there's a lot of options as far as what we can do when we receive an annuity as an inheritance. The first option, again, is to cash out, which is an option almost everywhere, where you just call up the company and say, send me the check. And of course, once you have the check, then you can do with the next step with it, whatever that might be. You can also disclaim your share of an annuity, and then it will go to other heirs, similar to a retirement plan. Now, again, you want to make sure you understand where it's going to go next before you disclaim it, so that it goes someplace that you would approve of versus going to a different family or a different beneficiary. Now, in annuities, there's also usually some sort of claim packet that you get from the annuity company. And there's choices within that claim packet where you can say, I'll take the money as a check, I will take the money over 5 years or over 10 years, or I will roll it over into this type of investment or that type of investment. So again, there's often a number of choices on the claims packet. Now, not all annuity companies provide every option in the claims packet. So sometimes there's options that they're not offering that you could have if you went to a different annuity company. And that's the final option. So the final option that we have is a 1035 exchange. So you can use a 1035 exchange to shift the money and assets from the annuity that you currently have into a different annuity. And if you do it as a 1035 exchange, you'll avoid all taxes and ramifications as far as the federal government and taxes are concerned. Now, there may be some surrender charges or other reasons why you may not want to do this. But in general, it allows you to change the annuity type. You can go from a fixed annuity to a variable annuity. And you can also change what options you have as far as taking the money out, Where some companies may not offer the options you're looking for, you can go to a different company and get better options. Now, once you do a 1035 exchange to a beneficiary annuity, either at the same company or a new company, now you have new rules. And again, you can't just let the money grow, and you can't take it over as if it was your own annuity. You still need to maintain it as a beneficiary annuity. So you have to do the paperwork properly. But once you make that change, your options now are to take the money out over 5 years in any combination or in any way you'd like to. So you could take it out all at once. You could divide it by 5 and take it out over 5 years. You could take random amounts for each of the 5 years. As long as it's done within those 5 years, you've met the rules. So you take it all out within 5 years. You could also cash out the account. Again, you can just say, send me a check. I've decided that we just need all the money now, and you can cash it out all at once. You can annuitize it. So that's one of the benefits of an annuity, is they have annuitization options, may be beneficial in a college planning situation, and they also just may be beneficial for your overall financial planning, where you can say, send me $5,000 as long as I live, or send me $7,000 for the next 10 years, or whatever the annuitization may look like. And you can work with the annuity company to figure out what your options actually are. And then finally, there's a concept called a stretch annuity, which allows you to take the money out over your own life expectancy. So you take out a very small amount every year, but you can do that for years and years and years. And then you always have the option of taking out more. So each year you have a required minimum distribution, and then every year after that, you have another required minimum distribution, but you can take out more. So sometimes it makes sense to use this option and then take out the money over 7 or 10 years, but you have flexibility as far as how much you take out each year. So you can use that and plan around college or plan around financial aid. So that's an option that we use quite often in order to minimize the impact of an annuity when we're dealing with need-based financial aid. So let's look at how a beneficiary annuity impacts your need-based aid. So for the FAFSA, generally annuities are not considered an asset. So once again, we don't have to report the $100,000 that's in the annuity. Now when it comes to withdrawals, that certainly will be taxable, or at least a portion of it. So you may get some basis and some growth, and portions will be taxable, portions may not be taxable. But all of that income potentially shows up on the FAFSA because it flows through your tax return and shows up as either income and actually increases your AGI, or it shows up as non-taxed income and the FAFSA takes it into account either way. So again, annuities can have an impact, the withdrawals especially, on your overall need-based aid, and that's why we'd want to do some planning around when we take the money out. I've just recently worked on a situation where it made sense for us to annuitize a particular annuity because there were large surrender charges if we cashed out. So in this example, it was roughly a $100,000 annuity, and if we cashed it out, then we would have only gotten about $60,000. Whereas if we leave it at this company but annuitize it, they would annuitize the full $100,000. So we didn't make sense to take the hit, so we ended up having to annuitize and take the money over 5 years. Even though we'd have liked to gone to a different company, it just didn't make financial sense. All right, so those are the retirement assets that we've covered so far. So let's talk a little bit more about the non-retirement assets. So there's 4 main categories: our investments, real estate, and then the cash and insurance proceeds. Now, all of these things can come to us relatively tax-free. So we'll get a step up in basis for a lot of the investments. So the stocks and bonds and real estate may all get a step up in basis. So if anything we sell right near date of death, a lot of times there's minimal taxes on that. And then of course, insurance proceeds and bank accounts, generally there aren't any taxes associated with that either because there isn't any growth. Original owners paid all the taxes in the case of bank accounts, and life insurance proceeds are always tax-free. So once we receive those assets, then we typically might put that into our bank or whatever it might be. And if we keep them as they were, they're all considered assets when it comes to the FAFSA. So All our stocks and bonds and real estate that are not our primary residence and life insurance proceeds, all of these things are all considered assets and have an impact on aid. So the next step, of course, would be to cash them in and collect them up and put them into your own bank. Now, of course, it's still an asset and you still need to report it. But now we have a planning opportunity where we can then go to the next step, which is move the money into a new investment of some sort. We can move it into annuities or 529 plans as part of our college planning. We could move it into different or better stocks or bonds or investments than what we originally inherited. So we have a lot of options, and it really depends on where we stand with need-based aid, where we stand with taxes. And quite frankly, many families are going to use some of this money to actually pay the college bills. So we need to keep some of it accessible potentially so that we can actually pay the bills. So finally, we have college savings plans. Now, college savings plans are a little different than other assets in that they have a beneficiary, but the beneficiary of a college savings plan is actually the student that's going off to college. It's not who receives it when the original owner passes on. So the successor owner who is the person that actually receives the account. So in this example, if grandma passes away, the money would roll down to mom, and mom would take over where grandma left off. So when grandma's alive, she owns the college plan. She determines when and how to spend the money on Susie's behalf for her college. If grandma passes away, then it rolls down to mom. Mom now makes the decisions as far as who gets the money and how it's spent on college. And then mom should set up a new successor owner, and it might be dad or it might be a brother or sister, but she needs to have a new successor owner in case something happens to mom, who would then take over next. And occasionally you could put the student in that role if they're old enough to manage their own money on their own behalf. So college savings plans, again, are a little bit different in that the beneficiary is not who receives it. So you need to be aware of the successor owner instead. All right, so as I mentioned earlier, there's lots of planning opportunities when it comes to receiving an inheritance. So we have all the various assets that we've already talked about where we may be able to move the money tax-free. And then we also have the withdrawals from retirement accounts. So we have to take out our required minimum distributions, or we might strategically take money out of an old 401k or whatever it might be. And once we take the money out, then we need to move it to the next stop. And that could be in the bank in order to pay for college. That could be moved on to stocks or bonds or investments, 529s. Now, another more challenging strategy is we could move it into mom and dad's retirement. And if we do that, again, now we're shifting the asset to an area where we'll not have to report it again. Now, doing that, of course, there's challenges and limits to how much you can put into retirement and your IRAs and those types of things. But it is a strategy that we use pretty often where we can shelter some of the money, especially if college is still a couple years away and we have the opportunity to shift it around a little bit before college actually happens. But there's a lot of planning opportunities when it comes to college and inheritance. You need to understand all the options and use them accordingly. All right, so that's all we have for this video. So we have the inheritance asset comparison chart, and you can receive this chart along with all the other great information in this video by signing up for our inheritance guide for busy parents. Just follow the links below this video and you can give us your email and we'll get that out to you right away.